So I welcome everyone on the panel discussions on valuation. It is an exciting panel and very interesting as we have Mr. Mark Zyla from USA, who also brings, besides being a practitioner on valuation, he also comes as the chair of IVSC Standard Review Board. Mr. Ashish is coming from Duff and Phelps. So again, bringing in perspective from Singapore and global perspectives. Mr. Rajan Wadhawan is from PwC, and again, he's a practitioner. So he will be sharing his perspective on M&A aspects. And we have with us Mr. Vineet Rathi, who comes from a registered valuer entity. He's a partner of RNC Valuecon. So it's very interesting time because, like the first panel, we all discussed that there is a lot of money that's waiting to be invested in different parts of the countries, but COVID has only subsided the investments, and slowly and steadily we have seen that the M&A activity is increasing. We touched upon some aspects of Zomato valuations, the recent startups, and different perspectives. So what I'll do, I'll just take it step by step. And first, let's understand about the global perspective about how IVSC standards are helping the global economies. And it's very important because at the same time in India, the Indian valuation standards are under formalization. So may I request Mrs. Zyla to share his perspectives on IVSC and if there are any learnings that as an Indian fraternity we can make at the moment. Mrs. Zyla.
Thank you, Chander, and thank you so much for the invitation to speak to you this morning or this evening, your time. As Nick mentioned, as Chander mentioned, in addition to being a practitioner here in Atlanta, I also chair the Standards Review Board of the IVSC. And the function of the Standards Review Board within IVSC is to harmonize the standards for, which is referred to as IVS, which is the only global multidisciplinary set of valuation standards. And we work with three technical boards: a business valuation board, a financial instruments board, and a tangible assets board, and develop a comprehensive set of international global valuation standards. The reason why this is important, if you think about valuation, and if you think about, say, for example, the merger and acquisition process, valuation's a vital part of that process, and it's a vital part of well-functioning global capital markets. So if you think about just a typical M&A transaction, when you're doing a deal, the target, there's a valuation of the target. So how much we need to pay for that target. There may be tax consequences to that transaction. So therefore, there may be a need for a valuation for tax purposes. Under both international accounting standards and here in the United States under U.S. need for financial reporting of that transaction, of identifying the value of the individual assets that are acquired. So that requires a valuation. If there are issues with the transaction, if there's eventually an insolvency, the insolvency might involve a valuation. If there's litigation resulting from the transaction, that might involve evaluation. So it's part of just general transactions. There are numerous reasons why there's a need for valuations, and it goes to back to what Nick was presenting. There needs to be a common set of standards. So if evaluation is done in Delhi or Denver or in Dallas or anywhere across the world, there needs to be consistent methodology, ways that the valuation is doing in order to enhance the efficiency of the capital markets. One of the things that we as a profession are struggling with is, are we operating in a manner that enhances the public trust? And I think that the IVSC goes a long way to answering that question. If you think about valuation compared to other professions, If you are an accountant, you follow accounting standards, you have a certain set of education requirements. Sometimes you have to have a accounting license, depending on which jurisdiction. If you make a mistake, there are consequences. If you think about it as a lawyer, if you're a lawyer, you have to have a common set of education requirements. You have to have, you follow certain procedures as promulgated by the bar in various jurisdictions. If you make mistakes, there are consequences. In the valuation profession, there really isn't that same level of consistency across the profession. So there have been some concerns from regulators, as we've seen in India, in the United States with the SEC, that there's been some concern expressed about our profession. Because of what we do, and it's involved in the public trust in transactions, in financial reporting, in tax work, the regulators concerned about the consistency and the quality of valuation. So I think the IVSC goes a long way of setting common set of multidisciplinary global set of standards. Some of the projects that we're currently working on to enhance IVS, the current set of standards is referred to as IVS, or International Valuation Standards. As Nick was mentioning, we have well over 100 organizations that follow some form of IVS. We also, as Standards Review Board, one of our roles is to be a voice of the profession. So we provide advice to other standard setters as far as providing input as valuation components of, for example, accounting standards with the IASB, with the Financial Accounting Standards Board here in the United States. We've had conversations with organizations like IOSCO about valuation issues as a general concept. We've had conversations with large banks through our Financial Instruments Board to setting financial instruments standards worldwide. Some of the projects that we're currently working on that we see the future of the valuation profession, one that's been mentioned a couple of times during this webinar, is ESG. We see ESG as an important, not only important issue today as a society, a global society, but it's an important issue within valuation. If you think about ESG, there's three kind of buckets of measurement. There's the measurement of actually the impact of ESG, which we see through some ratings agencies. There's the financial impact, financial reporting impact of ESG, which we're starting to see with organizations like the IASB in developing a sustainability board, and the EU in their discussions with FRAG as far as developing accounting standards to measure ESG. And then the third concept, it involves us, valuation specialists, because ESG has a critical component in investments. As the keynote was mentioning earlier, a lot of investment funds are focusing on ESG issues. Well, the question now is, how do you measure that valuation impact? And so we, as an organization within the IVSC, we're starting to gather information, how ESG is being considered in valuations, how technically you measure the impact of this really complex issue. So we're looking at ESG. Another area where we see a growing interest is internally generated intangible assets. As the economic consequences of the pandemic have accelerated the trend towards more technology-based sectors, we see more value going to those particular sectors. When you look at the market cap to the book value, the question is, how do we measure that? How do we measure the value of the intangible assets if it's not being measured by financial reporting? So we're looking at internally generated intangible assets. We're working with accounting standard setters, similarly, to look at how goodwill is being measured and what exactly is goodwill that's resulting from transactions. A key issue that we're working on through our Financial Instruments Board is setting common global financial instrument standards. That's been an issue, of course, in the financial crisis in 2007, 2008. where there was not a common set of valuation standards for the securities that caused the issues in a global meltdown of that particular crisis. So we're working to set a common set of valuation standards in financial instruments. We're also dealing with and helping the profession deal with issues like market uncertainty. How do you deal with valuation issues that caused by the current global pandemic? So with that, I'll leave it to the other panelists, but I just want to encourage adherence to and think about recognition and adherence to common set of valuation standards, because it aids the public trust in the work that we do.
Yeah. So I'll just take it from where you have left, Mark. You just touched upon technology companies and how the valuation is getting shifted to the technology companies. And see, I'll just give a small example. On 23rd of this month, Zomato got listed. And if you look into the market cap of Zomato today, it's about 1.1 lakh crores. So it has a top line of about 2100 crores. It got listed at a market cap to sales of 28 times, which Mr. Damodaran had valued at about 41 rupees. It got listed at 76. Yesterday, Friday, it was, I think, 136. So it has grown about 90% over and above the market price in less than a week. So getting about 50x of top line. So I would ask Ashish if he can give some perspectives on the early stage companies, because so far what has happened that when we were valuing these kind of companies, there were not enough comparables in Indian markets. So we were looking at, global markets, Alibaba, Amazon, those kind of companies. But now with Zomato, there will be Paytm, there will be MobiKwik, there will be many companies. So how should we value? Can we actually value it? Because you need to also look at it from regulatory perspective. Regulators are asking you to follow a particular methodology, and if you don't follow the methodology, and if there is a gap, then there are tax elements also involved. So Ashish.
Thank you, everyone, and glad to be on this panel with the esteemed people on the same screen. Just taking from what Mark said, see the one of the key things that IVSC talks about and what the IVS talks about, and I happen to wear a second hat of being a standards and technical work group member for the Institute of Values and Appraisals Singapore. So one of the key things that we always talk about, what is the purpose of the valuation? The purpose then defines how you go about doing the valuation, what's the basis of value that you use, etc., etc., etc. So when you look at something like Zomato going at 28 times, trading today at 50 times, for a company where of the stage that Zomato is in, 40 times, 50 times of revenue is not off the chart. Now, whether that is a sustainable multiple, definitely not. Because anytime when you're talking 40, 50 times multiples on revenue, there's a huge amount of growth built into that. So if you even look at things like, say, look at an Uber, which got listed a long time back, or look at Lyft, which got listed a little while back. They were also at that point in time trading that high, because they weren't at the 28, 50 times. They were probably at about 20, 22 times. And over time, they have stabilized on that multiple. It's still a higher multiple compared to traditional businesses, but they do stabilize. So to your question on what is driving this 50 times, one, I think what the previous panel said, there's a lot of gunpowder. So that's where the private equity and the funds are coming in. People need to justify the living. They need to justify the fact that they need to put in the money and make it to use. Everybody has their 220 to worry about. And the other thing is a lot of, if I put myself 20 years back, when the internet bubble burst, before that, a lot of people made money on it. You go back to 2008 when the GFC happened. Again, a lot of people rode the wave and made money on it. And more often than not, you hear of these success stories rather than the people who jumped off of buildings, metaphorically and otherwise. So there is this whole bunch of 20-somethings who have started earning, believe in these business models because they are the ones who are using it and are willing to put their money into these investments because they believe it's going to grow. So that's where the retail investors are coming from. So if you kind of try and break down who's trading on these tickers over the last since 23rd, you'll see it's going to be a mix of a lot of the individual investors trying to ride the wave, and a lot of funds who initially came in to make the investment and use their gunpowder to that extent. We also happen to do valuation for funds. So the same question that is trading at 50 times, why can't I get 50 times today? Well, you have to look at what is sustainable. And when it comes to financial reporting, people tend to be more conservative. So those are parameters that come in. I can see Mark smiling. Yeah, philosophy remains the same. You got to be conservative when you're reporting.
Yeah.
Hope that answers the question, Chander. Happy to go into more details.
Yes, that gives a perspective. I'm not sure whether that answers or not, but thanks for that.
There are no right answers right now.
There are no right answers. Yeah, actually, that is a correct answer. So let's just move on M&A perspectives. We have Mr. Wadhawan, and Mr. Wadhawan brings a lot of experience. And yesterday I was reading that there is a company, Syngenta India. And what has happened in that company is that company got delisted many years back, and now there is a capital reduction happening. There is some voice. Yes. Yeah. So what has happened is that NCLT has ordered to pay fair value to the shareholders, and that reminds me of a case which Mr. Wadhawan would recall very well. That is Cadbury India judgment in case of capital reduction. So M&A brings to my mind, first of all, minority shareholders. There are many proxy advisory firms who are giving their comments on M&A, whether you should do or not. Minority shareholders have got activated. The kind of valuation expectations sometimes is not reasonable. So what are your perspectives, sir? You can just share.
See, it's. I would like to answer it in a very generic manner in certain ways. See, a minority shareholder depends on what the situation at a particular point of time is. When you're doing a valuation for any of this delisting purposes, the company is already delisted, right? Typically, if you were to go into any other market, there would be much more issues around, whether illiquidity, the discount around aspects like minority and majority. In India, unfortunately, there are not many studies which are available to that extent typically, and others are here who would have operated in other Ashish there and all that. And in developed markets like US, UK, or even in Singapore, the discounts for a minority can be as much as 40-45% vis-a-vis majority, right? And we've also seen in Indian context that typically people pay a premium of 25% to getting a control sort of a thing, or varies again across industries from 15 to 40 and all that. But I just use it as an indicator. Now, what happens now? Unfortunately, in India or in a number of places, the issue which comes up is the valuation fair? On what basis the valuation has been done? It's at the end of it, it's a transaction between the shareholder and the company. Right? You as the valuer perform the valuation and give the report. It's a justifiable listing. It is up to you. Now comes the critical question, which is can I force? Is it necessary for the minority shareholder to accept it or not accept it? Fine. Till a couple of years back, it was not. The law now gives majority the flexibility to it. Now comes the question of how many people, the entire process followed in valuation, and that's the way someone should look at it. If there are 5 people who do a valuation, you got 2 valuers, you got 2 merchant bankers coming in providing a fairness opinion on that valuation. There is an independent board, right, over here who's supposed to be protecting anyway. The independent directors have been required to protect the interest of the minority shareholders. So they've gone through all the workings, and that's how they're recommending it. I don't know what extent, what more can be done by everyone in that sense. You are getting into the fiduciary responsibility of an independent director or someone else who's there on the board and is recommending. He's seen all the stuff, right? And I will draw an analogy. It's not a question of Cadbury, and I recollect that this happened way back in early 2000s also, where there was one valuation which was carried out by one firm, another by another firm, who decided, okay, let's get another third valuer to come into it. And again, when the third valuer also gave a report, it was in close proximity to this thing. Now, typically in any large organization, not getting into a small outfit, but typically a company will have a board managed company will obviously have its own plans and everything, right? Which would have got approved from the board. They would have gone through the process and all that, and a person performs the valuation basis that.
Yes, you're right, sir. But what has happened is that valuation has become a soft target, and so I would like to ask this. I would like to connect it with Mark. And Mark, is there any guidance in the international valuation standards on? A valuer has done the diligence, submitted a report. He could have given, another valuer might have given a different valuation. You might not like a report at all, but is there a guidance on to what extent a valuer has to do? Because as far as the standards go, standards give us the principles, but how do we apply the principles? Maybe whether CIV credential is helping on this. Please.
Yeah, that's an excellent question. I think standards by their nature, and I think you point to IVS are typically principles based, right? They're providing guidance as far as the technical aspects of valuation, but obviously each situation is different, so we're applying principles similar to accounting standards, right? IASB. As far as how much work needs to be done as opposed to how to do it, I think you're right on point, Chander. At least one thing we can point to is the Fair Value Quality Initiative here in the United States. When they developed the CEIV credential, they developed something called the Mandatory Performance Framework, which is a requirement for CEIV credential holders that in order to, it provides guidance to them that they have to follow how much work has to be done. So for an example might be, if management gives you prospective financial information, you just can't blindly take it. You have to go through certain steps to ascertain that prospective financial information is reasonable for use of it. So right now, the only thing I'm aware of as far as the how much is something like the MPF.
Yeah.
And just quickly distinguishing it, MPF is a framework. It's not a standard per se. So there's a difference between ethical standards, technical standards, and then frameworks.
Yes. So coming back to Mr. Wadhawan, so sir, how do you see that the M&A valuations are typically different from? So one, there is a controlling stakes involved, but how is it different and from the other valuations? Can we compare the private equity, venture capital, M&A valuations with other kind of valuations?
I don't see the valuation principles remain the same, right? Now the question is, when a private equity investor is investing into this thing, into any startup or something, like what you used the example of Zomato, right? Or even let's take an example of a Flipkart. The valuations varied at a particular point of time when the investors were coming into the entity, or whenever they were investing. valuations always at a particular point of time, right? And they invested, and in fact, in certain cases, let's take the case of Flipkart itself, the investors did write down at a particular point of time the valuation from a 16 billion number, it came down to around 12 billion or something like that. People have taken those calls on the basis of the reporting which they may have had to do, and the circumstances over here. Like Ashish spoke about today, the markets are at in a pretty buoyant mood because so much of currency or the gunpowder is around, and people are investing into this. So people are also willing to take perhaps higher risk, invest, and it's like the 20s, the kids who are just getting into the jobs, they are also getting associated with the markets. We perhaps could be going through a revolution. If you look at it, typically in early 90s, early 80s, people used to think more about manufacturing company. Look at GE, what are we going to invest? There are tangible assets, this and that. Then slowly things started moving towards the IT or the services space, right? And now we are moving towards the technology space or the view which is being given out in technology. Now, the key question over there is when you are talking about technology is, what qualifies as a technology. You've also had a situation like, a WeWork situation where there could be a meltdown because at the end of it, you are not in a similar situation that what are you doing? You're getting rentals accumulated and then putting it out on this thing. So investing in a transaction when you're doing evaluations for a private equity, your primarily financial thing could be the driving factor over there. One of the critical things is when do I exit out, how much return I make and all that. Whereas typically when you're trying to do a M&A, and I'm saying it's like a merger in a normal sense that two corporates are deciding to merge or something of that sort. They are looking perhaps at much more of the synergy side, what the combined entity valuation can be, and then the evaluation goes into this thing. Eventually, the whole idea of any M&A transaction is that transaction should be value accretive to the shareholders, right? Otherwise, why would I buy something if it is going to destroy value for me? Those are certain underlying principles. But if you're talking about a company being private, let's take the example of Vedanta, right? They also came out with an offer when the commodity cycle had not taken an upswing, and they came out with an offer at a particular price, but the shareholders did not accept it because they felt perhaps it's worth more. So those are it's like what you say, price is different from value, right? So it's up to shareholders that they can negotiate, they can ask for a higher price or not.
Yes. And probably one learning is that, transactions are taking place at the equilibrium of demand and supply. I mean,
that I think is a function of right now, the global economy, the kind of currency which has been printed, whether you take a look at US, in India, the deficits have gone to a different level, right? And that what has happened. So everyone is also looking at, there are fewer quality stocks which are available, and people are willing to risk also. The risk-taking ability of the individual is much more. And the other thing which you've noticed is, let's take the case of US and other places where you have the youngsters or people are able to take calls, and they are even able to take large funds or investors to the wall, right? They can understand with the complex logarithms and all that, they can work out whether the market has been short sold, a particular stock has been short sold, let's cover it up or take it to the other position. But those situations are not based on so-called value, right? But they could be based on people are taking position of the advantage of the situation in a particular stock position, which are there.
Yeah. And I was just looking at the data. So if we look into the 7-month IPO numbers, I think India has crossed 42,000 crores. And with the other IPOs in pipeline, it is expected that year 2021 itself will cross 1 lakh crores. So, and this 1 lakh crores doesn't include the divestment plan from LIC, which could itself be about 50,000 to 1 lakh crores, maybe just at a 5%, 7%, 10% stake. So what happens ideally is that once we move away from M&A and once companies reach a saturation stage, that is typically at a level when this IVSC code come into play. Because we have touched upon the growth stage companies, startup companies, but the way these distressed companies are valued is actually different. So I would request Vineet to just share his perspective and practical experience on how the distressed companies are differently valued than the startup and growth stage companies.
Good morning and good evening, everyone. Well, very, very appropriate question, because all valuing a growth stage company and valuing an IVC company or a company which is undergoing stress at this point in time is entirely different. The first thing that we notice is the availability of data sets. The data sets are seldom available when you are valuing an IVC company. The quality of data that is available could also be questioned. When it comes to valuing an IVC company, we are primarily valuing the assets of the company, whereas when you're valuing a growth stage company, you may be valuing an assets of the company, but you could also look to value. You could look to do an enterprise valuation through income approach and various other approaches that are available, which generally is very difficult in the IVC stage. What happens when you're valuing an asset of a IVC company, you need to carry out physical verifications of various assets, including inventory, whether the data sets are available to carry out those physical verifications, whether the assets have been identified and stored correctly, whether the verifications could be carried out in an ideal situation is also a big question. As I mentioned, you're primarily valuing the assets in the IVC company, and when you're as such valuing the debtors or the loans and advances and other such SFA assets, whether the balance confirmations, most of the time balance confirmations are not available. The correspondences pertaining to recovery from such debtors or loans and advances are not available. What if there is any dispute under those balances? What is the status of those disputes? Whether enough activity has been done in order to resolve those disputes and recover those balances? Whether the corporate or whether the RP resolution professional does have enough information to continue with respect to recovery of those assets is also questioned. Most of the time we have seen the resolution professional hardly has information to conduct appropriate measures to recover those disputed dues. What do you do in such cases? Also, one of the critical things is in an IVC stage, you are expected to value a particular asset on an historical valuation, as on a particular date in past. Most of the time, you hardly have a market value of such assets available at the historical date. Whether do you consider the events occurring after the balance sheet date or the valuation date for the purpose of your valuation is also one critical point. In fact, here IVSC, the way it is has defined, and probably valuation standards that we follow in India have defined it differently. The standards in India do mention that you could consider events occurring after the valuation date for the purpose of valuing an asset as on the valuation date, which also throws up critical issues while valuing such companies. Also, a lot of challenges that are thrown up while we are valuing IVC companies is the maximization of value is at the forefront for any RP, and you end up you are always asked for valuing an asset which is not forming part of that balance sheet. For example, for infrastructure company, say pre-qualifications form a major part of an entry barrier for any infrastructure company. How do you value such pre-qualifications? Does such pre-qualification have any value? primarily, if you really ask me, pre-qualifications does definitely have value, because that is an entry barrier for any infrastructure company to enter into that particular field. But then, do you really have data sets to be able to carry out valuations for such pre-qualifications? These are some of the challenges that we keep on facing while we value companies under IVSC stage, and there are no easy answers to that.
Yes. Thanks, Vineet. So I would just like Ashish, see, there are a couple of very interesting points you have made, and I totally agree with that. One is the limitation of data. Now, if a valuer is doing valuation and the data is not available, Ashish, and I would also come to Mark also and to Mr. Wadhawan also, how do we facilitate? Because there is certain guidance on assumptions and special assumptions in the IVS, but if the valuer writes in the report that I have not got this data, is the valuation compliant with IVS? Ashish, first you, then Mark, then Mr. Wadhawan.
Sure, gladly. So yeah, in the past, before IVS came out, we could have done that, taken on a mandate, do a valuation. As you're going through it, you realize certain information is not available, and that limits the ability to say use a particular approach. I think over the last few years that has changed. The thinking has changed, the approach has changed. There's a lot of time spent and a lot of stress before taking on the engagement to assess what's available, and say if for a certain mandate there's any reason that you say can't do. Let's say if PFI is not available, if there are no projections available, and you have to use just a market approach, then you put it in the engagement letter itself. So that helps us align with what is the requirement under IVS, because what IVS says is have your scope clearly defined. So the scope is clearly defined, and then you follow through on it. If it is during the process of the engagement, then you have to put relevant disclosures. Now, if you're looking at what to do when the information is not available, I think that's very case-to-case specific situation, and it can be a conversation in itself. But from what I have seen over the years that I've been doing valuation, you can usually find some reasonable way to assess a number. And maybe if I take IVC as a particular specific situation, the focus on IVC is looking at the asset cost or the asset value. So if there are no projections and no PFIs, that's totally fine, because the purpose is very different. And again, IVS talks about that too. It says it's a liquidation value. If it's not a for sale value, it's a liquidation value. Yeah. So that again does address that. Yeah.
So let
Chander and Ashish, and I have a question here, and which is an important one. So Ashish, when you say, so now if there is an asset which we cannot value, or where the data sets are not available, we do mention not ascertainable. Whether can we mention not ascertainable, or should we mention zero? How should we? And if you mention not ascertainable, while the table of assets shows value net of not ascertainable, and as you are aware, generally people look at the bottom of the table as the value and not what is in between.
Yeah, so the way we've dealt with that is you won't put zero, because you can't ascertain that it's zero. So you're right, you should go not ascertainable. And again, getting prescriptive here, which I shouldn't have, but if it's not ascertainable, it is not ascertainable. And as long as the due process has been done by the valuer, you cannot be faulted on it. And I go back to one of the questions Chander asked in terms of at what point can you pull up a valuer for what they have done or not done. You'll be surprised, there's case law which says that if a valuer has a mathematical error in the model leading to a particular wrong value, you cannot fault the valuer on it. There's an error, too bad. There are very limited areas in which under a legal situation, a valuation will be thrown out. And those are all around process, negligence, and good faith. So the onus of doing it right comes from standards and processes, because even in a litigation situation, the stress is, have you followed the right process? Have you done all that you could?
Yeah.
And as long as that disclosure is there, I think it should be fine. And Mark, maybe you can say I'm all wrong.
No, I mean, I agree 100% with what you're saying. I think it's a matter of transparency and disclosure, both if you can in the engagement letter and in your report, so that the reader is aware of if there are any limitations or changes on agreed upon scope, that the reader is aware of that. And if you can measure the impact on the valuation, perhaps do that as well.
Yeah, and that recalls me of the draft valuers bill, which is actually pending in India. And a very interesting point which I see there is that the valuer bona fide is presumed there. So unless and until it is proved that valuer has done something otherwise, the bona fide is presumed. There are some other issues, but yes, that is one point. So I think we have about 5 minutes with us. So maybe we can all take 2 minutes, 1 to 2 minutes each, and just summarize the session, please. Mr. Wadhawan, your final thoughts.
So I think the important thing is about the disclosure, what you can forget, what you can take a call. I think that is a must. The important thing over here is, and what Ashish spoke about, I was going to talk about the similar situation, right? See, if a valuer has followed the process, Chander, your judgment and my judgment can be different. I may apply a 10% discount, you might apply a 5% discount. That's within our judgment. That's why they call valuations the art or the science, right? It's science in terms that the processes to be followed or the approaches to be followed have been defined. The principles have been defined that this is the way you need to do it. Now, the art is the experience of the person who is performing a valuation. The calls which he's taking, is he taking the right call? My call or your call can be the same, but there can be a difference of opinion on the discount which I may apply or you may apply. That is a different thing. So, the key question which everything comes down to is, has the valuer followed the right process? He's followed the right process. Has he done enough work on this thing, and that can be justified or supported? Now, whether it goes into public domain or it is put out in the report, that is again a very, very tricky question. Especially in a country like India or any other place, it can be a very tricky question, because let's take the example, if you're doing the valuation for a minority shareholder, he anyway does not have access to the long-range business plan. All those plans are being made by the board, and independent directors who are supposed to be protecting his interest are taking a look at it when all those things are being done. Now, is there a possibility of any of the future information being viewed by a regulator as a forward-looking statement? Can it open up the entire company to it? The other is, can that information be also used by a competitor for a business plan? So, disclosure of information is a case-by-case situation. How it is displayed and set out has to be again taken in the context of each individual transaction. But your working papers and your engagement dynamics, or initially when you enter into an engagement letter and all that, you should absolutely make yourself clear. This is what is going out, and that's how you should write out your report also. And if any regulator or anyone's got any question, all that, those supporting documents can be provided and that can be worked out, At the end of it, in any profession you are, each profession carries some risk or the other, right? So you can't say that as a professional, my work cannot be questioned.
Yes, you're right, sir. And that makes me believe that even though India is still formulating the valuation standards, but I think we all would agree that even in 30-40 minutes of discussions, there were different deliberations and different options which came up. And probably IVS, even if adapted, or even if India makes its own standards, if we adopt ICAI valuation standards, it will be more application and following a proper process that will actually make a valuation strong. Whether it is an M&A brings special importance because there are minority shareholders, there are proxy investors, people are looking at it more. If they look at a normal valuation as well, probably the same kind of questions would come. The kind of assumptions, the kind of special assumptions that are being disclosed, whether the process is followed, whether the standards are followed, and at the end of the day, what is the kind of judgment that the valuer is taking. So probably I see that yes, the ecosystem of valuation in India is still at an evolving stage, and yes, at this stage the benefit or doubt should go to the valuer as far as the bona fide is concerned, and we must learn, add more of the knowledge, value additions, because there are many webinars now started happening on topics like valuations. And rather than going too much into technicalities, if a valuation passes a thumb rule, then I think that is a better valuation rather than a valuation in which we are debating of n number of complicated inputs. So with this, I think we are at the end of the session. Any panelist, if you want to add something, please go ahead for a minute, and then we'll move it to the third panel.
I'll just quickly add that I would encourage everyone that's participating to think of themselves as part of a global profession. And in accordance with that, it aids the public trust in the type of work we do.
Yes, that's right. Yes, Raj, over to you.